Hello everyone, my name is John Locke. I'd like to welcome you to The Winning Trade. But first, the required disclaimer material. This presentation is for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any trade recommendations. Also, please be aware that your risk in trading options is substantial, and please make sure you're aware of all your risks prior to placing any trades. Also note that in the presentation, we are using hypothetical computer simulated trades and/or results. They're believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many, many different reasons. If this is your first experience with us, my name is John Locke. I'm a trading performance and success coach with Locke in Your Success LLC, where myself and my team are here to help you win in the markets and in life as well. And today I'm here to guide you into the realm of high probability income trading. Now in a moment we're going to go over the winning trade, but before we do, let me quickly explain what I mean by an income or high probability trading strategy. An income strategy is where we put ourselves in the position to generate profits through the passage of time rather than depending solely on price movement alone, meaning we can often make money whether the price goes up, down, or sideways. Now this doesn't mean we're going to make money all the time, but it does mean that there's a lot better chance of us winning than there would be otherwise. When you find that you want more information, simply contact us at lockeinyoursuccess.com. That's L-O-C-K-E. inyoursuccess.com, or ask a question in the comments on this video and we can direct you to where you can find more information, or I'll answer those questions myself personally. Alright, let's move on. The strategy we're going to be discussing today is called an M3.4U. This is a somewhat bullish bias, market neutral income strategy that we trade on the Russell 2000. It requires a minimum of $2,500 planned capital per trade. Our example size today is going to be $5,000 planned capital. Now when we talk about planned capital, this isn't necessarily the amount we have in the trade at all times. Planned capital is a representation of the maximum amount that we should have in the trade after adjustments or anything else that we might do in the strategy. Realistically, it would be very, very uncommon for us to have any more than, say, $4,000 in this particular $5,000 planned capital position. But that's what we call planned capital. We use that number to derive our profit targets, our maximum loss numbers, and what our risk parameters essentially should be with the position. So with this particular position, the M3.4U, we do not have a profit target, but in general, I would expect a good month to be around a 10% return on our planned capital. And our exit loss trigger on the position is also what we could call 10% of planned capital. And in the case of our $5,000 example position, our maximum loss would be $500. All right, so let's take a look here at the strategy. Okay, so the M3.4U is what we would call a broken wing butterfly. And a broken wing butterfly is when we sell options in one location and then we buy options to cover that in other locations in a way where it creates a triangle looking risk graph with one wing larger than the other wing. Okay, so in this example or with this software, let me try to explain this a little bit. It's called OptionNet Explorer, and what it does is it analyzes the positions that we have on so that we understand the risk in the positions and where the profit areas would be in the position. So in this particular case, we have an asset price of, this is the Russell 2000. The last asset price on this as of, we have 3:35 in the afternoon here, Eastern Time. The asset price was right around 1378.25, and when we enter this position, what we're going to do is we're going to sell put options, and we're going to sell the short strikes about 17 to 27 points under the market. So if we have an asset price of 1378, we're going to be looking at selling the 1360s. So we come down here, we sell the 1360s. In this case, it's a $5,000 position. We're going to sell 4 of them. We'll buy 2 options, 6 strikes down, so or 60 points down. So if we sell the 1360s here, we're going to buy the 1300s. And this is going to give us a 60-point wing to the downside. And then we're going to go 40 points to the upside, 10, 20, 30, 40. And then we would buy 2 of these. And we're just going to do that for the model. Just for the modeling purposes. So if I just go back to our entry here, -1 + 1, This would give us two options at the 1400 strike level. And if we were to do that, and you take a look at the green, this is what the position would look like. Now we want to model this position to see what kind of delta we have. Is it going to be positive delta, negative delta, zero delta? It's all going to depend on the implied volatility skew curve at any given time. So in this particular case here, we would have positive 4.8 delta. Now the adjustment parameters, so in other words, we're going to enter the position and then we're going to have adjustment parameters, or parameters we're going to use to make movements on the trade to tell us that there is too much risk in one direction or the other, and it's going to trigger some sort of an adjustment or a position change. So this particular position, this size, $5,000 position, is going to allow positive 4 delta. On the modeled position with a standard 60-40 wing, we have 4.81 delta. That's too high. So to correct that delta, what we're going to do is, instead of putting 2 here at 1400, we're going to look at putting 1 at 1400 and 1 at 1410. When we do that, that gives us 2.88 delta. That is within range. So we can enter the position that way. So in this case here, we're going to be entering one put broken wing butterfly with a 1300 long strike, 1360 short strikes, and a 1400 long strike. And we're going to be entering one broken wing butterfly with a 1300 long strike, a 1360 short strike, and one 1410 strike. So we'll be entering this as in two different trades. And this is the resultant position we're going to get. Now when you look at this, the blue line, the straight edge blue line, is what we call our expiration graph, and that is the value of the position, or what it's going to be at expiration when everything expires at any given asset price of the Russell 2000. So your asset price of the Russell 2000 is across the bottom. Right now we're at 1378. We put the position on. The current value of the position here is essentially we're going to be down a little bit of money because we have trade execution and so forth. So we're down a little bit of money here. This line that projects off the dot is called a T plus 0 line, or the time plus 0 line, what the value is worth at any given price point of the Russell Index today. And that's a projected value. And then again, we have our expiration line, which tells you what the value is at expiration. That's essentially how to read this. Our dollars profit and loss is up and down the side. Here is where the delta comes in. It tells us, and for those of you who don't know what delta is, it's the projected gain or loss in the position with a $1 price movement of the asset in either direction. And then our current profit and loss is sitting right in here. So this is our entry position. From here, what we're going to do is, if we hit our positive delta number, then, and that's going to be positive 4 in this case, we are going to take this upper wing and we're going to widen it out. And you can see here that if I were to make this move, it would take our delta from 2.88 to minus 0.97, and that would flatten us out. And then if the price goes down too far and I can no longer correct it with the upside, then we're going to do what we call a rollback. We're going to sell the position off. We're going to reset and try again. If the market goes up and we hit minus 3 delta on a position this size and we're inside the tent, then we're going to make an adjustment there. Once we get outside the long strike, so once we get over, in this case we have a long strike at 1400, 1410, so once we get over 1405, we're going to be looking at adjusting at 0 delta rather than minus 3. So that's what we have going on. So let's go forward and we'll see how this goes. So here we went ahead to July 1st. The market's gone up a bit. It's outside the tent and it's over our long strikes. At this point, we're not making any adjustments. When this turns negative delta, we are going to start making adjustments on this. So let's just push this forward and you can see how the trade develops here over time. And remember, in this trade here, we have a $500 maximum loss, and $500 profit would be 10%. Right now we're at, what, 367, so we're doing well. We're still running about 1.5 positive delta, so that's looking good. And now, let's see, it's July 16th, so keep in mind the amount of time has gone by. We entered this trade on the 26th of June, and it's now July 16th. It's a good 10 or 11 days here, and we're just doing nothing. We're just waiting and watching it gain value. We go to the 17th, and we notice that our trade has started to turn negative delta. And we're outside our long strike here, where the asset price is higher than 14.05, which would be our official adjustment point if we were negative delta. So that being the case, we're going to take this here and move it to there. So what we do is we'd sell a vertical. We put a vertical order in and sell off our 1410s, buy our 1400, and that's going to put us to positive 2 delta. That's within range, so that's perfectly fine. And then we would execute that order, and we would end up in this position here. Now, we're going to shorten this swing, but we're also going to watch our capital level to the downside. And if our capital level starts to get excessive, over $4,000 in this case, then we're going to start reducing that by also bringing up this lower wing, which you'll see in the next adjustment. So if we go here and move ahead a few more days, our profit and loss, by the way, is now $650, so we're up over 10% of our planned capital. Very nice return building in this. So this day here, we are, let me take off the adjustment. The trade has turned negative delta again. You see it's minus 0.5 delta. Again, we're outside of our upper long strikes, so we require an adjustment. Now, this case here, I can do the same thing, but that starts to put our capital up over $4,000, and we generally don't want it too much more than that. So what I would tend to do instead is, or in addition to that, is to roll up our long strike here. When we do that, that makes us negative delta again. So we're going to have to be a little more aggressive up here. And when we do that, that gives us a positive 1.92 delta. That's a nice delta range for this trade. So what we'll do is we'll come in, we'll put in a condor order. We'll just sell a put condor with a 1400, 1390, 1300, 1310 strikes. And we'll execute that order, and that will put us into this position here. And if we move forward from here, we go to August 4th. We're now 17 days to expiration. Again, we're hitting the negative delta numbers. We're up $877, which is good. What's that? About probably 16, 17% on our planned capital. So that's trade's going nicely so far. Same thing here. We're going to roll these down and take a look at this. This starts to put us up over 4,000 again, so I'd imagine I did that condor order like I did last time. Let me see if that's what we actually did. So right now we're at 1310 and 1390. Yeah, we go to 1320 and 1380 by selling a condor, or selling a condor order just like we did before. That gives us a positive 1.35 delta, keeps our risk amount in the trade that we want. And if we move forward from here, this is how the rest of the position plays out. I don't know that there were any more adjustments. At some point, the value in the the extrinsic value in this option becomes almost zero, at which point you could take the trade off early, but generally we're going to almost expire these, so a lot of the times we might expire them. Alright, so that was the exit of the trade. So let's go back here and look at our August position. So we go all the way until this point, which is August 17th. And you can see that there's only 17 cents left in this upper option, and there's 10 cents in the shorter options. You could either just let this expire. I probably wouldn't make another adjustment on this at this point, although you could. But usually if there's no time premium in here, it's not really worth it. So I'm negative delta. Normally I'd call for an adjustment. I have the choice here. I could leave it alone and just take whatever I have at expiration. I could try and close it, or I could try to adjust it, which would be our maximum adjustment on this strategy, by the way. But the reality is, all this does is it adds more downside risk, and it really doesn't make a whole lot of difference in our expiration line here. So I could make this move if I wanted to, but generally I'm going to choose not to. It's not really worth it. So in this case here, we just exited the position. So let me clear this. We come in here, exit. For a profit of $941, or almost very close to 20% return on our planned capital of $5,000. So that was a fantastic trade for our August M3.4U. As you can see, our September trade, if I take this off, this is an overlapping trade, so you'll have two trades on at once. You can see this date here. Our September trade is also doing amazingly well. It's up $260 already with still 32 days to expiration. And if you go to today, this trade is still doing well, as is our new October trade also. So that is the M3.4U, this episode's winning trade. If you like what you see, I encourage you to join us and discover how you too can follow along with this and many other great income trading strategies on our Options Trading for Income webinars that we have every single week. And where you can also learn about upcoming winning trade presentations. And perhaps best of all, you can get information on our Trading Performance podcast, where you can learn to improve your trading regardless of the type of trading you do. If you have any questions or comments or anything you'd like to see on the next winning trade, we'd love to hear from you. Simply comment on the video below. We'd also encourage you to come on over to thewinningtrade.com. That's thewinningtrade.com, where you can find past episodes of The Winning Trade, as well as a lot of other fantastic bonus information on how to profit through income trading. And please remember to subscribe and comment on our YouTube channel, where I will personally answer any question you may have. Thank you, and we'll see you on the next winning trade.